Day trading is one of the most efficient ways and also one of the most effective ways of improving your trading skill. The objective of day trading should not be to make you wealthy beyond your means. In fact, it is highly unlikely that you're going to get there through day trading. Rather, the objective of day trading has to be that you're going to be far more skilled than other traders who are taking a very long time to experience the market moves and relative volatility that you experience on shorter times. To be a successful day trader is an essential prerequisite to become a successful trader. And in continuation with the series on how to plan a day trade, I would discuss the price action that has unfolded today and the common traps that are going to be set for day traders as they approach the market on Monday. So, as we can see, that the market has given a bearish crossover on the hourly chart. The chart that I'm used to making an assessment is the hourly chart, and the crossover is a death crossover or a bearish crossover because the faster moving average is trading below the slower moving average. Here I have selected the 2050 moving averages, which means the red line is representing the average of 20 hours of trading, whereas the green line is representing the average of 50 hours of closing price in trading. Since 20 is the more recent number, because it is trading below the 50, it means that the recent price closes are below the longer term price closes, and therefore this bearish crossover is usually an indication of a downward or a bearish trend. But like I said, this downward or a bearish trend is for the perspective of the day trader, and the analysis that a day trader does is applicable for not more than one day in the market, which means the analysis that we are doing today on a Friday will only be applicable for Monday. And at the end of the day on Monday, one would have to analyze the market again in order to make a trading plan for Tuesday. So now we can see a death crossover, we can see downward sloping moving averages, we can see series of lower tops, and whenever the market has consolidated into a range, it has broken down, forming a sort of breakaway gap structure. The price action today has been even more sharp, where the market gapped down after a cluster and continued to trade lower almost throughout the day, indicating that this or confirming that this is indeed a bearish trend. In my video previously, I mentioned that all trends can be divided into three types till eventually we reach the fourth type. So the three types are a strong trend, a value zone trend, a weak trend, and finally we enter into a range. Now, what is the meaning of a strong trend? So a strong trend means that a pullback or a throwback has only occurred till the slower moving average, which in this case is the 20 moving average. Which in this case is the 20 moving average. Value zone means that the pullback or the throwback has happened between the 20 and the 50 moving averages. That is, it is between the 20 and the 50 moving average. A weak trend means that the pullback or the throwback. Pullback means a corrective move in an uptrend. A throwback means a reactive move in a downtrend. So a pullback or a throwback has been up to the 50 moving average. A range is basically when the pullback and the throwback has far exceeded the 50 moving average, and the moving averages are now going to change the nature of crossover. They're going to change the nature of crossover. Since we are trend traders, or in general aspire to be trend traders, most trading is going to happen in the first three categories. That is, either a security is trending strong, or it is somewhere in a value zone, or it is trending extremely weak. But the moment the security changes its trend to a range, at that time trend traders typically opt out of that security and range traders opt into that security. Trend traders, whenever they assess the trend, will necessarily long the options, which means they will either buy the CE or they will buy the PE in the direction of the trend. A range trader, whenever they assess the trend, they are going to short options, which means they are going to be your option writers. If a range trader deploys the short option strategy on a trending market, it could be career ending for them. Similarly, if a trend trader deploys option buying strategy into a ranging market, it could be career ending for them also. So while a system is largely related to when we enter and when we exit, the whole purpose of assessing a trend is to identify what instruments are we going to trade and why are we trading them. So with this in mind, let's have a look at the price action again. These are the same zones that I had marked earlier. You will note that at this point, there has been a throwback relative. So I'll just select a simple trend line, and you will note that after the bearish crossover, there had been a throwback somewhere in between the 2050, which means that this is behaving like a bearish value zone security, because after the bearish crossover, it has come between the two moving averages. Subsequently, we can show that this security adopted a range for the longest time till finally it retested but this time the 50 moving average, making it a bearish weak security. Subsequently, this stock once again came to the previous lows. I'll just select this here. The stock came to the previous lows, then created a new low, as we can see, with a gap down. And while creating a new low, it created a very shallow high till the 20 period moving average, at which point the assessment would be bearish strong. This is exactly what we have mentioned up, the rules of interpreting the chart. Now logically, if you see the video in continuation, you will note that in the video I had mentioned that the trader should now, since the trend is strong, should look at buying the options, and since the crossover is downward, the plan will be to buy a put option, and certain methods were taught on how and what strike price we will select. But now let us understand that the move has happened in the direction of the structural trend. Let us understand where the traps are likely to happen. Now on Monday, if the market gaps down, the question is, what do we do? In fact, in general, what is the plan for Monday? Now, since we can decisively say that the trend is bearish strong, we know that the plan has to be to sell the rise. And since the trend is bearish strong, the first point of sell has to be the 20 MA. Now you will note that Nifty's closing price is 22,125, whereas the 20 MA is 22,435, almost 300 or 310 points above its closing price. Now if the market, in other words, the trading plan then starts becoming simple. If gap up 350 points or more, then sell. And how would do that? We would buy the PE. However, if anything other than this gap, the answer is we will not trade. Now the question is, why should one not trade? And the reason for that is because we have to sell the rise. In the absence of a rise, a day trader simply cannot sell. Now, because the market is bearish weak or bearish strong, as we have just assessed, and it is currently at the lows of the day, we need to wait for the market to rally up to at least the first moving average in order to theoretically initiate a sell. But what is most likely to happen? Most likely on Monday, when the markets gap down, most amateur traders will hit the sell button, and they will end up selling the market in exceptionally oversold conditions near previous lows. And then what is likely to happen is that the market could then react strongly upwards as a relief rally somewhere towards its 20 moving average, which currently is at 22,450, but during the day will come to around 22,300. And here the seller of either the gap down or near the lows of this value is likely to get trapped. The objective of doing this exercise is to come to terms that even though we have on the hourly charts a bearish view on the market, even though the market has complied and traded on the bearish side, Monday, unless and until there is a 350 point gap up or more, there is simply no trade to be taken, particularly on a Monday morning. And the next question that the trader needs to answer is are they going to sell at the 20 moving average or the 50 moving average or somewhere in between? You see, each trader would be unique. Some traders would only want to sell at the 20, some only at the 50, some in between the two. However, it is my view that the trader should decide even beforehand what they plan to do on the market. One of the surest and the most efficient ways of losing capital in the market is to come in the market without a plan. Even if the plan is wrong, there are certain guidelines which will force you to change the plan. If it is sure that you are going to make an assessment on the hourly chart, then always stick to the hourly chart and do not change the time frame to the monthly or the weekly, because there your assessment of trend will change entirely and the plan to approach the market too will change entirely. Also, just because a stock is trending, it does not allow you to just initiate a sell or a buy. One has to wait for the rise to sell the rise, and one has to wait for the pullback to buy the dip. In the absence of the two, a trader is generally looking for trouble. So, as a day trader, if there is a continuation move, you actually have no trade on Monday, and you would have to sit back and watch the market hopefully rally all the way up somewhere between its 20 and 50 moving average for you to potentially be able to short on a Tuesday or Wednesday. And day traders need to come to these terms and look for securities outside of the market, outside of this nifty market, in order to potentially be able to sell on a Monday. This understanding is important and critical, and hopefully this video will prevent some traders from letting impulses and adrenaline take over if they see the market open up on a red on Monday morning. And now the other question is, should you buy the gap down or should you buy the red open on a Monday morning, since it is expected or it is very natural for the market to revert back to the mean? And then my answer is, what is the point of doing all the trend analysis, and what is the point of all that jargon that trend is your friend and that you should stay in the direction of the trend, if at the end of the day you are going to come back and counter trend trade? If you would like to buy the market, then I would suggest simply change your time frames, move on to longer time frames, and here you will see that on the monthly the market is trading at the value zone. So if there is an individual who has months of view on the market, such an individual would almost now be drooling because of the opportunities that the market has presented. Please note that this is the first time that Nifty has traded below its 20-month average from March 2023. That is almost 2 years. After almost 2 years of trading, this is the first time the index has come to the value zone, that is here. And other than COVID, every time the index has approached the value zone, it has taken support and moved up. Other than COVID, every time the index approached the value zone, it eventually took support and rallied up. It is very rare for the index to trade and breach the 50 period moving average. So if you're looking to buy the market, then you should be looking to buy the market as a trader who is seeing monthly time frames, which is a technical investor or a trend trader. Whereas if you're trading on the hourly chart, there is simply no question of you looking at buying this particular market simply because you're hoping for a reaction rally. The trend reality for different traders will be different because they're looking at different time frames, even if they're looking at the same security. With this, I hope that you have understood a few things about the process of planning, and also understood slightly better that why, when research analysts like myself either appear on social media or on television or other places and give seemingly conflicting views of the same security, that's largely because the time frame in which the individual is asking that assessment is different. So, once again, a small wrap up. It is highly unlikely that a day trader who would have a sell the rise bias is going to get an opportunity to sell the market on Monday. That day trader needs to wait for a 300 or more point gap up in order to be active in the morning. Otherwise, for all practical purposes, if you're a day trader who's exclusively trading Nifty 50, you can take a holiday from trading the market on Monday. I hope this has been informative in some way. We will meet in the subsequent videos.